Hi and welcome to this week's edition of Macro Minutes. I'm your head of trading, Mark Gardner. It's the 23rd of July. Start with a disclosure statement. So the information summarised in this webinar does not constitute financial or other professional advice. It is general in nature and does not take into account your specific circumstances and should not be acted upon without the full understanding of your current situation or future goals and objectives. Okay, so stocks in our universe, we've got Rio, BHP and ANZ this week, so three of the big ones. Now, Rio on the 16th of July updated the market with the release of its quarterly activities report. It highlighted how the company continued to face challenges related to COVID-induced labour shortages, higher rainfall in the Pilbara region despite the global recovering economy. Comparing half one 2021 to half one 2020, production fell across commodities apart from aluminium and titanium dioxide slag, with mine copper and the clear underperforming segment falling 11% from the first half of 2020. So that it expects its iron ore, copper and bauxite shipments to be at the lower end of the guidance range. It's removed the titanium dioxide slag production guidance given the risks around the timing of a resumption of the operations in South Africa. Pilbara also increased its iron ore 2021 cost guidance to between 18 to 18.50, up from 16.70 to 17.70, an average cost increase of about 6.1%. This reflects the escalation in the prices of key inputs such as diesel and labour, COVID-19 related costs, and MyHeritage management costs. So yeah, look, Rio did take a little bit of a hit on the back of that news. Obviously, but we're still looking for materials overall in this reporting season to be, to be the outperformers. So hopefully, just brings it back to a comfortable price where you can maybe be looking to get in. Next up, we've got BHP. In contrast to Rio, BHP reported a relatively strong quarterly update on the 20th, revealing their production and costs were in line with the middle of the guidance. Record production was achieved in iron ore and copper. Petroleum production was slightly above guidance. Full year production of copper, iron ore, nickel, metallurgical coal were in line with the guidance, as was revised guidance for energy coal. First production was successfully achieved at four major developments during the year, all of which were delivered on budget and ahead of schedule. These projects include an iron ore project, a copper project, petroleum, oil and gas. Labour shortages were flagged, but unlike major rival Rio, BHP said the shortage hadn't increased production costs. In total, 72.8 megatons of iron was produced in the quarter, with 73.7 megaton iron was exported, contributed to a record full year 283.8 megatons sold in the year. So BHP also flagged this week, or there's a rumour floating around from a Bloomberg article that they were looking to sell off their gas and oil assets. So that sort of sent the price higher. It's one of my favoured ones for reporting season. They are a diversified miner. Coal prices have gone, very hard to the upside, more so even than iron ore and copper. And it's about 14% of BHP's revenue, which didn't contribute anything last reporting season. The coal price has gone through the roof since then, so that'll be a good contributor. It's around the $51 mark, $52 mark at the moment. But look, there were periods over the week where it was down around the $49 mark. I'd be pretty interested to be buying anywhere below the $50 mark into reporting season. We'll just sort of see how things go there, I suppose. But as opposed to something like Fortescue, where the rally's already happened, it's up around the 25.50 mark. There's probably a little bit too much risk in that one to be buying looking for dividends. Although look, we're going to have an absolute stellar reporting season for these materials companies. Next up, we've got ANZ. On the 20th, they announced their intention to conduct a $1.5 billion share buyback as part of the capital management plan. Purchase of the shares will commence in August. They consider the buyback to be the most prudent, fairest, flexible method to return capital in the current environment. As of March, Tier 1 capital ratio stood at 12.4, well over APRA's requirement of 10.5. The on-market buyback is expected to reduce their CET1 ratio by 35 basis points. The announcement came hours after APRA announced its capital relief for deferred loans. Given APRA's tactic approval, other major banks are expected to follow ANZ's surprise share buyback after the lockdown with capital returns of their own. Rightio, next up we've got a new section of the webinar. So this is my trading department's stock of the week. So I'll be basically focusing on an individual stock every week. Usually it'll be one of the recommendations, given we're sort of producing one, maybe two at best recommendations a week for that trading department. This week I've started off with PPE, people infrastructure. So look, as you can see here, we've got the chart on the left-hand side. To the right-hand side of the chart, there you can see the red and the green. Where the red and the green meets, that's where we're looking at the entry price, which is $4.30. The bottom of the red is where the stop out is, and the greens are the target prices. So to the right there, you've got the Maqro map, which is a snowflake representation of the risk-reward ratio, the RRR, conviction, trade size, beta, the perceived risk, and the thematic. Look, people infrastructure, they're a recruiter in the professional services, IT, sort of markets. Given the labour shortage at the moment, the unemployment rate's down at mining boom levels here in Australia at the moment at 4.9%. Even though we've had a string of lockdowns, we are still at number two in the OECD in terms of economic recovery out of COVID. COVID, while it might last for the next six to, or possibly the effects for 10 weeks, I can only really honestly see it as a way for the government to really escalate accelerate the vaccination rollout, and eventually move past that. Given this labour shortage that's coming up in basically every area of the labour market at the moment, the need for recruiters is going to be higher. These guys yield about 2% as well. As you can see from the chart, it's sort of sitting around that 100-day moving average, which is the yellow line that's through there. And then the 200-day moving average is down around about that 385 mark. It's been grinding higher since the post-pandemic lows around June. And basically we just would expect this thing to continue its rally up, as I said, recruiters have needed more. So look, the risk reward ratio is around 2.14. You're looking for a good 15. I think an average of about 17% if you're taking both target prices, and you're only risking about 8% for that privilege. So it should be the conviction rating is about 80%. It's a fairly low risk. I don't really see anything structurally changing in this area of the market. So yeah, and every week I'll be putting out one of these during the webinars. So you can have a look at those. All right, now we've got stocks to watch out for over the next week. We've got Microsoft, Apple, and Facebook. So look, Microsoft listed on the NASDAQ. Its fiscal year is the 1st of July to the 30th of June. It will publish its fourth quarter results on the 27th of July. The Q3 financial year 21 earnings per share results of 1.95 beat analyst expectations of 1.76 and have done so since Q4 financial year 16. The pandemic has accelerated digital adoption, with Q3 revenue and profit growth up 20% and 44% year on year respectively, largely driven by revenues of Microsoft Cloud and personal computing products increasing 33% year on year and 19% year on year, totaling 17 billion and 13 billion. Despite the chip shortages, Microsoft's strong tailwinds and revenue growths have analysts forecasting earnings per share of 190 and recommending a consensus buy. Next up, we've got Apple. Just to note, their fiscal year is the 1st of October to the 30th of September. They'll release their third quarter 21 financial year results on the 27th of July also. Their Q2 revenue hit all-time high of 89.6 billion, beating analyst prediction of 77.4 billion, prompting a $90 billion share buyback and a 7% dividend increase. Apple's EPS of 1 have been continually revised upwards over the last 90 days from 0.82. The CEO, Luca Maestri, has warned that the chip shortages may cost Apple about 3 to 4 billion in Q3. However, Q3 revenue is still predicted to grow by strong double digits, year on year, leading analysts to recommend and accumulate. Facebook, their fiscal year is just the calendar year, January 1st to December 31st. They're set to announce their second quarter FY21 results on the 28th of July, the day after. Q1 21 saw revenues increasing by 48% year on year, with net income increasing by 94% year on year, beating analysts' expectation earnings per share forecast of 2.35 by 40%, with an EPS of 3.3. Facebook stated Q2 guidance of revenue growth being moderately accelerative compared to the previous quarter, have analysts estimating Q2 growth of 60% year on year due to its historical conservative forecasts. Despite Facebook's introduction for users to opt out for tracking and ad targeting, analysts expect Q2 EPS of 3.04, leading to a consensus recommendation of buy. So those FANG stocks doing pretty well. Netflix has had a pretty hard time of it recently, but apart from that, most of those FANG stocks are doing quite well. And tech's sort of come back into favour now that the Fed's reaffirmed that they're happy to live with inflation. We'll overall have broader economic growth coming out of this, the last bits of the pandemic. Now, looking ahead, economic data to be released in the next week. We've got Aussie CPI, FOMC, Jackson Hole Conference, and US GDP. So next Wednesday, we've got Aussie CPI data. This data comes, relatively late in comparison to other major nations. Still the primary gauge of the Australian consumer prices and can have a large impact on the markets. We're still looking at wage growth probably being the focus of the RBA rather than CPI, although it does definitely have an influence. The trim mean is the RBA's preferred CPI number, which is a little bit less volatile, but headline numbers can affect things. You probably would expect there to be some increase in things like, used cars, etc., due to this chip shortage. So it's pretty similar to the US, but we're not going to have the same uplift in the holiday travel and things that they have as well, given we've just had recent lockdowns. Next Thursday at 4:30, the FOMC press conference will be held. Look, they've got the Jackson Hole, which is their annual conference. They don't have a habit of releasing stuff at this meeting. They tend to wait till the following month, but the market will definitely be interested in their, in the statement they release. We're going to have some, it'll be very closely watched given the negative reaction we had from the last time they released any statements. Next Thursday, then we'll have advanced GDP for the US. It's the earliest figure. It's a bit more volatile and tends to have a decent impact on the markets, but probably be focused on FOMC. Thanks for attending the Macro Minutes, and we'll chat again next week.